Hey, welcome back. If you've been on this channel before, you already know we don't sugarcoat things here, but we also never leave you without a plan. And today, that balance really matters because something big is shifting in the economy right now. And whether you have $500 in a savings account, you're carrying credit card debt, or you're trying to figure out how to invest for the first time, this affects you directly. Interest rate cuts are coming. And if you're not positioned for what's about to change, you could either miss a massive opportunity or get blindsided when things move fast. So stay with me because by the end of this video, you're going to understand exactly what's happening, who it hits hardest, what the government wants you to believe versus what's actually true, and most importantly, what you should actually do about it. Before we dive in real quick, I want you to know why I care about breaking this stuff down the way I do. I've been in tight financial spots. I know what it feels like to look at your bank account and feel your stomach drop. This channel exists because nobody was explaining the economy to regular people in plain English. Not to moms stretching a grocery budget. Not to veterans navigating benefits. Not to people on disability watching every single dollar. So that's what we do here. No finance degree required. Let's get into it. Here's what I want you to walk away with today. I want you to understand what's actually happening with interest rates. Not the Wall Street version, but your version. I want you to know the difference between the story the government is selling and the reality on the ground. And I want to give you concrete moves you can make right now before this shift fully arrives. So here's where I have to be real with you because this is a channel about truth and narratives. And right now, both matter. Last week, the CPI inflation report dropped. The headline number 2.4%. And honestly, my first reaction was, wow, that's a nice story. And here's the thing, the Federal Reserve and the federal government make their decisions based on narratives. They try to sell you a story, it's up to you whether you want to buy it. So yes, headline inflation came in at 2.4%, helped largely by gasoline prices falling about 8% year over year. When oil prices drop, it pulls down transportation, diesel, energy. It's a major input cost across the whole economy, and it made that inflation number look really clean. But here's what that 2.4% headline isn't telling you. Ground beef is up more than 16% year over year. Home health care is up more than 12%. Hospital care is up 7%. Funeral costs are up 6%. Public transit is up 5%. And don't even get me started on insurance premiums and property taxes. I would love for my property taxes to go up by just 2.4%. That is not the reality most of us are living. If you're a mom managing a household budget, you already know that ground beef at plus 16% is not an abstract statistic. That's dinner. If you're a veteran or on a fixed income, rising healthcare and transportation costs have been quietly devastating. If you're disabled, unemployed, or relying on benefits, you've been squeezed from every direction. Costs up, credit harder to access, and savings yields that barely kept pace. The headline number sounds great. Your lived experience probably doesn't match it. And that gap is exactly why we talk about this stuff here. Here's the narrative the Fed is now building. Their target inflation rate is 2.0%, 0%. With headline CPI at 2.4% and falling, the story becomes inflation is close enough to target. So now we can start cutting rates. But here's the thing. The Fed was originally cutting rates to protect the labor market. And right now, the labor market doesn't need rescuing. The most recent jobs report showed 130,000 jobs added. Unemployment falling from 4.1% in November down to 4.3% in January. That's a solid labor market. So the justification has quietly shifted. It's no longer we need to save jobs. Now, its inflation is low enough, so let's cut. Now, let me show you where the real action is. According to the CME FedWatch tool, at the next Fed meeting on March 18th, there's a 90.2% chance of no cut. The following meeting on April 29th, still a 71.5% chance of no cut. That April meeting, by the way, is the last one with Jerome Powell as Fed chair. Then things get interesting. By the June 17th meeting, that flips completely. Now there's a 68% chance of a cut. So in about 6 weeks between those two meetings, the odds completely reverse. Why? Because President Trump's expected new Fed chair nominee, Kevin Warsh, is likely to take over in mid-May. And the market is basically betting that Warsh will do Trump's bidding and cut rates. That's the market telling you it no longer believes the Federal Reserve is truly independent, not even for appearances. Here's where I get to bring you some genuinely good news, and I don't take that lightly. For people carrying debt, when rates drop, credit card APRs on variable rate cards will eventually follow. New loans, auto, personal, mortgage become more accessible. If you've been watching mortgage rates near 7 to 8% and wondering if homeownership is permanently out of reach, a meaningful rate drop could translate into hundreds of dollars less per month. That is life-changing money for families on the edge. For investors, rate cuts historically lift stocks broadly and give a strong tailwind to precious metals, particularly gold. And I want to explain the gold story clearly because it's actually straightforward right now. When interest rates are high, you can park money in a savings account and earn a solid yield with low inflation. No need for a safe haven. But when rates fall to something like 2%, inflation tends to rise and your savings yield drops to almost nothing. Suddenly, gold becomes a lot more attractive. And right now, gold is already getting a tailwind from dollarization. Other countries are actively choosing gold over US dollars as a reserve asset. Add money printing and incoming rate cuts on top of that. Gold is facing multiple tailwinds simultaneously. But here's the important warning, and I need to say this clearly because I care about you not making a painful mistake. Rate cuts will not be a rising tide that lifts all boats equally, especially in tech. This is where you have to ask yourself a critical question. Which companies are going to become obsolete by AI and which ones are going to benefit? Take Duolingo, a language learning app. Their stock chart over the past year is rough. And think about it from a consumer perspective. Why would you pay $12 a month for Duolingo when ChatGPT can give you vocabulary lessons, correct your grammar, explain regional slang, build you a custom daily study plan for free? Duolingo has no real moat against that disruption. Rate cuts alone won't fix that. Then look at Amazon, down about 12% over the past year, but the story is completely different. AI isn't going to magically build physical warehouses or fly delivery drones overnight. Amazon's moat is physical and logistical infrastructure that takes decades and billions to replicate. AI actually makes them more efficient. That's a company that can benefit from rate cuts and benefit from AI at the same time. The bottom line, rate cuts are a tailwind. But in certain industries, especially software and certain tech sectors, that tailwind may not be enough to offset disruption. Let me make this practical because information without action is just anxiety. If you're carrying high-interest credit card debt, start pursuing balanced transfer options or debt consolidation now before rates drop and everyone rushes to do the same thing. Get ahead of the crowd. If you have money in a high-yield savings account, enjoy those yields while they last, but start thinking about locking some in with CDs at today's rates before yields drop. For investors, even beginners, rate cut environments historically favor gold, dividend-paying stocks, REITs, and companies with strong physical infrastructure modes. You don't need a lot of money to start. The key is starting. And if home ownership is your goal, use this window to repair your credit and reduce your debt-to-income ratio. When rates drop, housing competition will heat up fast. Be ready. Look, I know it's exhausting to hear that the numbers the government publishes don't always match what you're feeling at the grocery store or the gas pump. That frustration is real and it's valid. But knowing the difference between the narrative and the truth, that's your edge. You're watching this. That means you're paying attention, and that puts you ahead of most people. Subscribe if you haven't yet, because we're going to keep tracking every step of this rate environment as it unfolds. And check out the video on screen right now. It goes deeper into managing debt and building an investment foundation in exactly this kind of economic moment. You've got this. I'll see you in the next